All right, so this is our second video. We're starting at 10:30 a.m. Um, and let me just move a couple of things around. Okay, now I could see it better. All right, so we were on this slide. This is the daily time frame, euro versus dollar. I talked about the change of character bar, which is going to identify a potential much more significant consolidation than any consolidation that we've seen on the way down. So now let's go into this area right here, because daily is still very ambiguous for us, day traders, to identify a more accurate point of entry. And we're going to look into this area and try to identify where else could we possibly structurally find a high probability point of entry. Now, when I'm talking about a high probability point of entry, I'm identifying it right here, which is definitely lower than the highest point of the trend right here. You probably might be asking yourself a question, why is he not talking about, like, let's say this entry right here or this entry right here? And we could definitely do that. We could definitely talk about these entries, but there are quite a few other things to talk about. So I think that you could identify these entries by yourselves in terms of, where exactly you're coming in, how do you decipher the structure that you have here, and so on and so forth. I'm concentrating only on the high probability points of entry, so usually those are going to be, after the commitment to the downside and after the failed attempt to go in the counter move and then the failure of that move. So those are the high probability trades for me. So here on the 240 minutes time frame, and as I mentioned in the introductions, I actually like this time frame for currencies, because see how nicely you see the whole structure here, which on the daily, is uh, somewhat obscured, in terms of the points of entry, not in terms of the structure, but in terms of where we actually would go in. And here on the 4 hours, it's much cleaner, and it goes from what, 6.5 to 7.8, so months and a half. So you could see the structure of months and a half on 4 hours so clearly. And again, movement to the downside, and we would be thinking about the change of character here. Why is this a change of character? Well, this is the largest reaction that we've seen, since this move started to develop. And this big bar, this big up bar, acts as a change of character bar. Again, very important bar right here. It basically tells us what's going to come, that consolidation is going to come, and that we are going to be bound in our intraday trading by the structure that's going to come. Now let's quickly talk about, and this is a very interesting thing that we'll explore later on, but this is also a really good example. So let's say that we've seen this bar right here, and we're saying, yes, we are going to consolidate. Now, what is the logic for our intraday trading here? Well, first of all, we're thinking that currently we are in phase A. Currently, we are in the automatic rally. And therefore, at some point, we're going to have a reversal to the downside, and we're going to retest a climactic action low. So how would we then build our trading tactics around this, structural ideas? Well, we obviously would be looking for some kind of stalling action on the way up. So somewhere here, we see that the spread is contracting. Then the next spread tries to go up, tries to commit and fails. So this is a really good indication of a potential upthrust action. And then we see that there is a trading range right here. So we would be looking into the structure here on the much smaller time frame, let's say 1 hour, 30 minutes, 15 minutes. And we would be looking for the phase analysis and the structure to be in the phase C and D, and probably somewhere here in this area on a smaller time frame we would find a point of entry. Now, as we are entering this, we are still thinking long-term structure, climactic action, automatic rally. We need to experience this secondary test, which is going to be a test of the climactic action, of the previous climactic action. And now our target is going to be this close and this low, so we can use it like that. So this is where we would expect the price to come. So therefore, if our point of entry is going to be somewhere here, let's say on this day, and I'm going to clean this up, let's say on this bar right here, or even on this bar. Now think about that you've entered here. Should you close this trade at the end of this move? What do you guys think? Write it down. Let me give me some kind of answer. Should we close it on the intraday basis there? If this is our session, if we're trading, let's say, only US session. Okay, so no, no, yes. Okay, any other answers? Okay, and I wonder what's the logic there, what's the rationale? So let's go to Ming. Okay, so Ming, so why wouldn't we close it there? I mean, if we are intraday traders, we kind of, our idea is to come to the session, let's say the session starts somewhere here on this bar, and then the session ends on this bar right here. So we want to be risk-free for the overnight action. We don't want to follow you know, longer term trade. So what would be the logic to keep it, to keep this position?
Well, for the intraday, probably you can close it right there, but it's still far away from the selling climax.
Yeah, yeah. This target that we are seeking here is still so far away. I mean, we've made already. Let's say if this is you know, let's say that the unit of risk was like this. So we probably made what, 1, 2, 3, maybe 4, maybe 3 units of risk. But we can double this profit if we wait for the price to come. We don't know whether it's going to be during the next session, or maybe you know, it might take 3 sessions. But here is this idea, here is this thought that we've initiated during the introduction session, and that is, if there is an opportunity, then why not take it? If there is an opportunity and it might go away, why not act on this right now? I mean, what if, and it kind of worked out really well for the next session here, so here's the next session, and I'm judging just by the velocity that that was the session. But I still don't know whether that was a London session, you know, European session, or whether it was the US session. So in that we'll talk about as well. But if we know that in the longer term structure, even in phase A, we're expecting a secondary test, and we have the target for that secondary test, and we're still far away from that test, I think this is where your day trading mentality should change, and you should start thinking a little bit more of a short-term swing trade. And if anything, you should accumulate more. I mean, there is definitely an opportunity to create another trade right here, but you know, life is so unpredictable for us. You know, you might be busy on the next day, right? And you might not even, you know, be there, you know, to open that trade again. But if you have your stop loss established, you moved your stop loss, this position is profitable. Currencies are always very liquid, so there is no problems with liquidity, maybe only in 2 events. Over the weekend, you might have a gap, and that's going to be the most unusual gap for the currency, that you're going to experience. And then another liquidity event that is possible is the intervention by the governments. These are the moments when you could have 200, 300, even sometimes 500 pips movements in the opposite direction, and you might be caught in that type of action. But those are rare, and even with those, you still have enough liquidity in currency, to withstand a very meaningful, counter move. So therefore, you could definitely utilize the knowledge of a larger structure in your day trading, and your bias is just going to be down, and you could increase the duration of your trade here. Let's look at this from a different perspective. Let's say that we are here right now, right? Let's just continue this discussion with you. So we are experiencing a secondary test. There is a structure here by itself, right? So we know that after the secondary test, what should happen structurally in the larger range?
Then it's going to go into the phase B, right?
Mm-hmm.
Maybe the up thrust or
attempt to
thrust action.
We're basically trying to retest the previous high, right, in phase B. And we might fail, so there is one failure, kind of like a second failure, and then we finally going into phase C right here. But we know that the directional bias is going to be to the upside at some point. So therefore, we also combining that with the idea that there is a smaller structure right here, and we might label that structure. So this seems like a change of character bar. So phase A, then B, phase C, sign of strength, and LPS. So if we label it like this, as the price develops, then we could day trade these elements right here, and we could trade them as isolating trades because this is a non-trending environment. And then once we experience the sign of strength and LPS, this is where the day trade is going to be much more significant. Again, change of character, consolidation, phase C, and then our bias is going to be to the upside. Now we already established a slope here with these 2 lows, so this slope is going to lead us to this area right here, and once we see some kind of reversal, again, we could be thinking here that what if this is phase B? Under this scenario, so what would be the next move? If we're still, let's say, in phase B, and it's just an upthrust in phase B.
Then it's going to be another secondary test.
Another attempt to retest this area right here, right? So under this scenario, the bias is what?
It's downside.
Down, okay. And then if we're thinking that this is phase C, upthrust of the distribution, what's the bias there?
It's also downside.
Also downside. So in both cases, the bias is to the downside, whether we are right about which phase we are in or not, and therefore we can intraday to the downside. And once we enter the position and you went through the first session, you kind of like thinking, there is still a lot of potential here. I don't really have to close the position. I can convert that and switch that into the swing trade and see whether the next session is going to bring me something, and the next session does, and then the next session starts having those contracted down spreads, so that that definitely helps to identify a change of character. and that suggests we're going to have some kind of consolidation right here. So you can change that intraday bias to a different bias, based on these conditions. But again, see how on the in a larger structure, just because of the structural points, we can create a specific intraday bias for us, and then all of the signals that we're going to take are going to be in the direction of that bias. Okay, thank you, Ming. Let's see, we have some comments. Okay, no, I would not close this position right here because although at the prior congestion, wait for trailing stop loss to be hit, target is still climactic action. Yes, absolutely, so that's a great comment. Another comment, before the high probability sell on the trading range at the top of the automatic rally, would we be buying intraday? Yeah, there would be still the bias to the upside, right? But we know that if this is a climactic action, and this definitely acts as a change of character automatic rally, so then at some point we're going to have some kind of reversal. So in effect, we're just waiting for that reversal in some kind of area of the congestion area, right? So here is the congestion, and here we would be looking for the signs of the reversal or the signs of inability to commit to the upside. So here is your inability to commit to the upside. Now, one of the things, Karen, we're going to discuss today is how can we talk about the bias in this area right here. So how can we explore, how can we establish the intraday bias based on the smaller structure? And again, as we did with the larger structure, right here, you're going to have your structural points. You can trade those, and you can change the bias based on those. So if this is 240, here you could go probably to 15 minutes, 30 minutes, and as you're having your structure, you can say that, okay, I've seen a change of character, so I'm in phase B. For the next session, what is my bias? Well, we need to retest the low, so my bias is going to be to the downside. Now, I've seen a swing reversal right here on the 15 minutes, so what's going to be my bias? My bias is going to be to the upside. What's going to be my target? Around the resistance. So therefore, we're always going to change the bias based on the structure, and we're always going to be aware of the, let's say, daily swing bias, and we're going to combine them, and we're going to try to identify, what's the best bias for the specific intraday session. And we'll talk more about this, later on. Now, again, I'm identifying this area as a high probability entry point for us after the sign of weakness, after the failure on the LPSY. And I want to go to a much lower time frame. I want to understand exactly the bar that I'm going to open positions in this area. And I also want to understand in Forex specifically what are going to be the bars and sessions where I'm going to open this position. Now, please note that all of my timing here is a Pacific timing, right? So I'm in the Pacific zone, I'm in San Francisco, so I prefer to have the local time, and just to understand, the New York time, that I'm behind 3 hours. So just keep that in mind when you look at the timestamp. So let's look at this structure. This is 30 minutes, and this is the same range as this one right here in this green box. So right away, you kind of can see a lot of points of entry. I identify those as, blue boxes, dark blue boxes, and green boxes. Now I will also put them into different sessions, so US session and European session. And you could see that there are quite a few entry points that are so great in the European session. So like this one, and it provides the first initial sell-off right here. This one, sell-off right here, and this one, sell-off right here. This is one of the nuances for Forex, and that is, and it's also occasionally true with indexes as well. Sometimes a specific market news related to a specific market is going to lead the moves. And you have to understand this as an intraday trader, especially as a Forex trader. You really have to think in terms of which market is leading the price and which market is creating the more meaningful moves. And even on this simple example, we see that European market is pushing the price down all the time, and euro is being sold aggressively by the European traders. In the US, we also have the same bias, the bias to the downside, right? So here is a session, here is a session, here is a session, and then here is a session. So in all of the US sessions, we have the same bias, but yet the strength is not there. So my focus on opening a more desirable a position in a more desirable place would be probably a concentration would be during the European markets. So I might stay up to, let's say, a midnight, just to see whether I'm going to have some kind of reversal, some kind of continuation or a breakout trade right there, establish that trade, then go to bed and then wake up for the US session in the morning and just to see where I am. If the price has advanced to the downside before the US session, I'm just basically moving my stop loss, and then I want to see what kind of reaction I'm going to have during the US session. If the US session is going to continue this weakness, I will compare two of the sessions, and then I'll make some kind of decision as to whether to close the position completely or to keep the position and convert that into the swing trade. So that was a really important point right here on this chart. Then another point here is, again, about the structural analysis, right? So we still want to identify high probability points. So let's say that we are somewhere here. We start analyzing the structure and we see that, okay, this was the first rally to the upside that was larger than any other rallies here on the upside, so therefore it acts as a change of character, and therefore this is an automatic rally, and the point before that is a secondary test. Climactic action. Secondary test comes almost at the same level, and this is our phase A, and currently we are potentially in phase B. You might be thinking that this could be phase C. So during the US session right here, your bias is going to be what? It's going to be to the downside, right? Because you're thinking that structurally, if you're in C, then you're waiting for the sign of weakness. So once you go to a much smaller time frame, so let's say 5 minutes, you're going to find some entry points around this area, and it's still before the support, so you actually might catch some of the move right here. Now, the challenge for this particular session, and I identify US sessions in this kind of like transparent green boxes right here, that you have the move, a very aggressive move to the upside. But you can avoid that move to the upside because if you're thinking a sign of weakness, what should come next? A rally, last point of supply rally. So maybe on the intraday basis, you don't want to participate in that rally, and therefore once the first signs on the lower time frame show you some changes of character, you are out. So you still can have a profitable trade here in the direction of the overall trend, and you might have a different trade to the upside. And now this trade to the upside, most likely, and this is one of my guidelines. So trade full size in the direction of the current bias. So we are definitely very heavy on the down bias right now before this session starts. And then trade lightly, and I mean in size, counter to the current bias. And there is nothing really new here, but for the intraday, that could be really crucial. Now, there is an exception to this. An exception is going to be if your bias changes because of the intraday structure. So what do I mean by that? So let's say that somewhere here there is a trading range, and then you see that there was maybe a phase C right here, a potential phase C, and that the price might have a sign of strength. So based on that, you don't want to be stuck with the previous, buys that is being depicted on a higher time frame, and you can actually go with the buys just based on the smaller time frame. And I'll show you that a little bit more. I think this is not the best example. Now, another idea here, and something for us to stop and think. Look at the US sessions, right? So if I'm a day trader in Forex and I'm trading Euro and I only trade US sessions, so I wake up maybe around 5 o'clock on the Pacific coast, because 5:30 a lot of the times you're going to have economic reports and currencies are very reactive to those, so you want to kind of like be there for that volatility if that's going to present itself. And with the reports, it's really easy because you know exactly when the reports are going to be released. So you know that tomorrow morning at 5:30 there's going to be a release of this and this report. So let's say that we are trading only US session. Look at all of the US sessions and what do you think of them? I mean, think of them in terms of the duration of the move to the downside, duration of the move where we have that bias, right? Look at that. Only 2 days, this one and this one, had somewhat of a good intraday action in this currency during the US session. So think about this. First of all, even though you might make money in the first instance right here, but probably that's going to be just one trade and you kind of done because the price is just so aggressively coming back into the trading range. Here you can potentially convert to a swing trade, but the price already committed so heavily to the downside right here, you might be inclined even to close this because you don't know whether you're going to potentially have some kind of rally right here. This range is not that aggressive, and it shows kind of like the same lack of aggression to the upside as this one. So you actually might be lucky here and the price can just go down. So that would be okay. But imagine that, the price actually, has this type of action. It could take you out. So we're coming back to the conversation of the all-around trader, universal kind of trader, the trader who not only sees the opportunity on the higher time frame, but the trader who can utilize that opportunity on smaller time frames at the correct time. So for a Forex trader, observing all of the action, and let's say again, if we are here, if I'm observing that there is more supply that's coming in during the European session, and then all US sessions are kind of like, smaller with an exception of this one. I'm going to be looking now to see what kind of reversals I'm going to have during the European session, and I would be inclined more to open that position and to hold on to that position from the European session, and then use US session to add to the current position. So let's look at that. How would we play this out? So structurally, when the price comes back, we definitely think that this is a sign of weakness, but we start questioning the phase. Are we really in phase D here on the sign of strength? Could we come back to this level again, or maybe even to this level, and have a potential phase C there as an upthrust? And as we're done with our US session here, we go in on the break. The day unfolds, and this is an Asian session right here. And we see that during the Asian session, the price comes back to this level, and we are clearly seeing that, okay, well, something is different. And this is where European session starts. And we see that there is a push to the upside, a reversal, and then a confirmation of that reversal in this area. So this area right here, it could be late during the night, like at midnight, 1 a.m., but this is our opportunity to open the position in this area, just based on the structural analysis that we've had, based on the price coming back to the trading range and changing that, labeling that we had previously. Also on the idea that the European session has a much better entry points currently, so European market is driving the price rather than the US market. So we enter here, and it could be a much smaller time frame. It could be a 3 minutes, 5 minutes, and then we might go away, put the stop loss, and just forget about this position, go to bed, and then came up back maybe like at 5 my time, or 8 New York time, and see where we are at with that position. So we would be looking at this position somewhere here. Well, first of all, we already have a profit, so that's great. Secondly, we're thinking in terms of the structure. So we are clearly in phase D at this point after phase C failure. So it acted as an upthrust, and it's confirmed. And we are touching right now with support. So we are expecting some kind of attempt to rally out of this area. We also have just experienced a change of character bar and a change of character relative to this whole move to the downside. So we are expecting maybe a rally or a consolidation. So our goal is just to look for the failure of that rally. Usually we're going to have some kind of, 1, 2, 3 type of move and then failure. So we're looking for that 1, 2, 3 and then failure. Or you can look at the consolidation, overall consolidation. In this case, might be upsloping a little bit. And you're looking for any type of upthrust action. In this case, the resistance works really well. So the price tries to commit, and this happened during Asian session. And then just because you've opened position here, you're thinking that US does not have the strength to push the price down here for Euro. So most likely, if you're going to have some kind of continuation, that's going to happen during the European session. So therefore, you're looking for that failure. You're looking for that continuation of that move to the downside during the European session. This is where it starts. And before it hits the resistance, you can open the position, and it could be a smaller position size than this one, but I probably would go with the full size here just to think that during the intraday you can easily close it, but if it works out, you're going to have a much bigger position size. So it works really nicely, and we're going into the US session here. We're seeing the same type of action as we saw here, some kind of upthrust action and a failure. So on a lower time frame, you want to catch this failure during the US session, and then again, you just want to see what's going to happen during the Asian session, whether to keep this position or not. Okay, and that's basically, how we would look at this. So you could see that looking at the structure on the, high time frame, this looks so much different to, going to the actual intraday action, right? So we don't understand what's happening here without going and looking at a much more specific area. Then even here, this is too much for us, how do we understand? I mean, we understand that the long-term bias is to the downside, but how can we open position, a high probability position, in the lower time frame? So going to a higher time frame on the intraday, lower time frame on the intraday, and even lower on the points of entry. And then once we entered here, so let's say that we've entered at 135.50, 135 maybe, 20, and maybe at 134.90 or 80 between. So these 3 points right here. Let's look at where we are with our entries right here. So we are entering somewhere here in this area, around 135. So now, as we've entered, and let's say that we've committed the majority of our capital. Now, what is the best thing to do here with that, sizable position? Should we close it on the next day and start day trading? We can definitely do that. Our bias is still to the downside on any of the intraday days that we're going to have. So if we trade intraday and we close the position and we just intraday trade this whole thing move to the downside, imagine how many trades you're going to have. On this number of trades, how many mistakes you're going to make. On this number of trades, if you're not switching to the swing trade, how many times are you going to miss an entry point just because you were sleeping, you were busy with your family, you were busy with your job, you didn't feel physically or mentally, kind of like, ready to even trade. And yet, if you convert this intraday trades with an understanding of a larger structure, that your daily structure and even weekly structure is to the downside, imagine this trade right here. Imagine that you're keeping it even longer, and your exit is here. What is the benefit of that? Fewer number of trades, fewer number of mistakes, much more sizable position, more profits because you're getting more, you're catching a much larger portion of the trend. And then you are less inclined to make mistakes, because what do you do with the swing trade? You just move in the stop loss. Like this, and then suddenly you see a change of character bar and you can just get out right away. So this could be a trade. And this would be such an awesome intraday to swing trade switch. And you could just go through the notions of day trading right here, day trading right here, and then establishing this position again right here in phase C, and then just going again at it until you experience a change of character bar, which just happens right here, and you're out here. So let's say that this is your next trade. And then again, you're day trading right here, establishing the day trading position, and then once these bars are happening, you're out. So 3 swing trades that could have been developed on the intraday level with the intraday level point of entry. Okay, question. Would you ever open a position in the Asian session? So usually I did not. So currently I don't trade Forex, but I've traded Forex for years, like for 10 years I've traded Forex. And it's just, you know, the hours for me are just so cruel. You know, I basically would stay from about 10, 11 p.m. and I would go through the whole London session, and then I would go into the New York session, and I wouldn't even be able to stay, you know, until like 9 a.m. So I would be done by 9 a.m. I would go to bed and sleep like until 1 or 2. So that kind of screwed up a little bit of my internal clock, and I stopped because of that, and I just said, you know, it's just a little bit too hard, even though it's just a lot of you know, Forex trading I like, because to me that was the initial instrument that got me into trading, so I have a little bit of the emotional attachment to Forex. And I've traded a lot of years, you know, in Forex, but again, you know, I prefer right now to sleep well and just not to worry about all those moves, and use other instruments. So like E-minis right now is probably my most preferred vehicle, because it's just easier, you know. I get up like at 6, and even that late, you know, if I do the analysis the day before, I'm ready, you know, and I can situate myself within the next hour. Usually the first 30 minutes is still going to be kind of like looking at what's going to happen first with the volatility. So coming back to the question about the Asian session, no, my preference was never, you know, to open a position during the Asian session unless we have some kind of volatility event there. Especially, you know, during this Sunday, you know, like late Sunday, the market starts, Asian session starts, and you know, you might have a gap, and then there is a tendency, you know, like to close that gap, or at least attempt to close that gap. So there is no reason for me to play that. I want to play this type of trades where, you know, I understand the overall long-term directional bias, where I understand the daily then lower time frame bias, where I understand the intraday structure, and where I understand the specificity of what pushes the market, like what session pushes the market. Once I understand that, then everything else is about the current structure, where we are, and the swing reversal. So once we have the swing reversal and position is opened, the larger trend is going to carry you through this trade. Larger trend is going to help you out, and it's going to push you, you know, with much more velocity to the exactly the point that you want to have as your profitable points. And if we look at the Asian session, I mean, look at this. Here is your Asian session right here. Here is your Asian session right here. Here is a continuation, so here that's kind of like, okay, that makes sense. Here's an Asian session right here. So in a lot of cases, there is a little bit of the counter move that we see here. So you might consider like, okay, if we have the counter move, could I open the position here? Yes, you can. And again, here the counter move actually reversed right here. Here the counter move started reversing right here. To a certain degree, yes, you definitely can use that. But again, I think that, you know, and I call this London session just because, you know, London is obviously the financial capital for Europe. So London session and US session are the most important ones. Yes, I was thinking more specific about specific things you're waiting for. For example, the upthrust at the last point of support at the end of that range. Okay, which range? Hold on a second, Karen. Let me unmute you. Which range?
Sorry, I meant the last point of supply, not support.
Yeah,
So,
yeah, I understood. This one?
yeah, that one.
Yeah. Okay, yeah, you could do that. you could wait for that, but imagine what kind of life you're going to have, right?
Okay.
Because Forex is 24 hours, so if you're thinking, oh, I'm going to catch that upthrust during the Asian session, I mean, you can, but you know, for the majority of people, that's not going to be the case. For the majority of day traders, we're probably going to be trading specific sessions. So, for instance, I had my hours from 10 p.m. to about 8 a.m. You know, during this time, and that was really difficult. You know, with Forex. Um, so I would be, whatever I'm given, I'm just trading that. But if you can't do that, that's fine as well. There is a little bit an element of risk because with Asian session also low volatility, so therefore any type of reversal during the London session is going to be, you know, somewhat quicker, so something like this right here. And we see how London session has more volatility than the Asian session. So you might be caught up, you know, in this counter move. So if you open it, you have to make sure that, you know, London confirms, you know, that move.
Brilliant. Thank you.
Okay, great. Okay, and this is it for this particular ideas for this particular segment, you know, with the currencies. Are there any questions before we go away from this case study? And hopefully now you guys are kind of seeing where I'm going with all of this. We're going to go into more details, but that was important for us to first start thinking structurally, start thinking about structure first, daily swings bias, you know, intraday structure as well, and then intraday swing reversals as well, and those high probability places of where we can open. And then again, specificity of the specific of the market. Okay, I see no questions, no other comments, so let's move on. So here's our second case study, and we're gonna now look into stocks. So the majority, well, actually, no, I should not say this. I was about to say that the majority of my students, you know, who are day traders, usually, you know, when we discuss that, there is a lot of discussions about day trading stocks. So, and obviously, you know, day trading stocks is still popular. I think that the most popular day trading stocks time was at the end of the 90s. That was such a crazy time. When on the intraday basis you could have like such big moves, like 10-20% moves, if you're catching the trend day in a stock. So right now it's slightly different, the landscape is slightly different, but still, you know, in a specific stocks you are going to have those big intraday moves that you want to catch. So we're going to look at specifically, you know, FEN stocks, those popular momentum stocks, and how we would trade them. How would we select a specific stock over another to trade on a specific day? And that's all going to be related to the market. So the questions here to discuss is, which stocks would we choose overall for intraday trading? How would you guys approach this? You know, let's hear some answers. How, what do you think about the stocks? I mean, there are 8,000 stocks. How do you choose the ones that you would think that are going to be the best for your intraday trade on a specific day? Let's see what kind of answers we're going to have here. And then also think about what's the preferred structural position. Could we, you know, are we looking for the stocks that are going to be trending currently in some kind of long-term trend, or are we looking for the stocks that are, let's say, in some kind of specific structural position in the trading range and so on and so forth? So Min is saying, okay, we're looking for the good spread and liquidity. And this is absolutely correct. We want to participate in stocks that are going to have that type of volatility, liquidity, for us to have enough room during the day to initiate the trade. Karen is saying, I look for instruments that are in favorably a daily structure, for instance, phase D or phase Z. So phase Z is going to be about a trend, established trend. And I think it's really good if we could combine these two ideas. So good spread and liquidity, and let's say a trend, established trend. Why is this a good idea? Well, because if the stock is in the uptrend, then what is the bias there? Most likely, most of the days, what's going to be the bias? It's going to be to the upside. If that stock also has good spread and good liquidity, and in other words, good volatility during the day, then we are trading, day trading in the direction of the major trend, and we are trading the stock that potentially could have a lot of room for us to day trade. So those 2 points are extremely good points. Another comment, big daily spreads equals volatility, better day trading. Absolutely. So that's exactly what we're talking about here. Okay, great. So let's look at this example. So we're going to look at Amazon, and the time frames that we're going to discuss is going to be a daily, 60 minutes, and then again, I forgot to put here, we're also going to look at, I believe, no, we actually, those are the 2 time frames. That's another case study. And we're going to look at the daily from the point of view of the swing price structure. We want to determine what the current trend is, where we are in the structure, and are we in some kind of stepping stone in the larger trend, and so on and so forth. And then on the 60 minutes, we're going to look for points of entry, and we're also going to look at the intraday price structure. So here's the original chart. This is daily. And again, if you're a day trader, you can't really start right away on the intraday time frame. You have to understand what is happening with the structure. So we are looking to trade in this area right here. Let's say that we are here. So how would we analyze? What elements of analysis are going to be important to us? So obviously structural analysis, right? So we want to identify the original range, and we want to look at the causality. So the cause is actually quite extensive. It's 1-year cause. So we're thinking that the trend that's going to come out of this causality is going to be significant. It's not going to be a 2 to 3 months trend. It's going to be a long-term trend. So therefore, we want to use this knowledge to understand, how aggressive we are going to be with our day trading at the specific spots. So we see that at the moment where we want to day trade this stock, we're already in the established trend. We already had 1, 2, 3 moves to the upside. And currently, structurally, we are in some kind of formation as well. So there is some kind of apex right here, and we are close to the resistance area, so we are close to breaking out. If we break out, we're probably going to have another move like this, another move like that, another move like that, something similar. And that's going to play out also in our thinking as to what to do next. We also want to before we actually select the stock, let me just come back in my thought process here. So I picked Amazon. Why Amazon? Well, again, we talked about, having a good volatility stock. And usually the easiest way to identify those volatility stocks is to look at the popular stocks. What is popular right now? What stocks are always in the news because they are moving, because they are momentum stocks? Well, right now there is an acronym here, FANG, right? So Facebook, Amazon, Netflix, and Google. This is the leadership signature that you're going to see in this type of stocks, where during the consolidation, we have a downtrend in their leadership, but then there is a break to the upside and the leadership resumes. And during the stepping stone, you're still going to be in the long-term trend right here. But on the short-term trend, that leadership is going to fade out. So if we're expecting the next move to the upside, on the short term, there's going to be exactly the same picture where there is a downtrend and then there is a resumption of that leadership. If you catch this, then you're basically catching a really good point of entry of not just for the intraday action to get involved, but also for a potential swing trade. Also, with the stepping stone structure or with any of the structures like this one, we want to look at the supply and demand signature. So we see that supply is contracting and the price is making higher lows. So that makes it a springboard that also indicates an absorption of the supply, where supply is contracting and the price is already registering higher lows. So that's a good place for us, to start thinking about, day trading this particular stock. So now let's look at 60 minutes. And here we see that we can go definitely into the structure as well. So like right here, there is a smaller structure. You can go into maybe like 15 minutes, 5 minutes, and try to decipher, what kind of structural events we have at this point. You could also rely just on the leadership because basically when the leadership resumes, that just tells you that the price is being pushed up. There is desire by big operators to mark up the price, and that's going to be reflected in this breakout. And therefore, you can open an intraday position, and you can open on the lower time frame, not necessarily 60 minutes. Open this intraday position, and then start thinking, what you're going to do with that. Are you going to just close it by the end of the day? Or are you going to keep it and switch it into the intraday position? Oh, I'm sorry, swing position. And you can do both, but my idea today, one of the main ideas is going to be, if you're opening a position on the intraday basis here, and you are in the stock that is in the established uptrend, you are in the momentum popular stock, and you're anticipating a potential swing move to the upside, try to leave this position on if it's entered at the correct timing, and try to capitalize on this move, because it's going to bring you more profits, and it's going to also keep you away from potential mistakes on the way up that you're going to make by day trading. Also, in a lot of instances, you're not going to have a desirable spread, to intraday trade this particular stock. So there are lots of benefits to use the intraday techniques for your swing trading, and we'll see more and more of that. If you would establish a position here and then you would be swing trading, your exit is going to be on this bar right here. This is a change of character bar, big bar, and I don't know if you guys could see it really well or not, which basically suggests a consolidation after that point. And we are going into the consolidation like this, change of character on the way out. So during this time, you can trade but you can trade the understanding of the structure. And then here you already trade in the swing. So it's very interesting how we can think in terms of those concepts, right? So for instance, change of character in a big structure. We know that the backing up action is going to come. Backing up action has its own trading range. So during this trading range, once we identify phase C and we intraday trade, we can establish a trade to the upside as a swing trade. Get out on a lot of supply right here, and then with our understanding of the how after climactic action change of character is going to develop, we're just going to trade the structure. How would we trade the structure? So on this swing, our bias is going to be to the downside. Why? Because of automatic reaction that we should have after the climactic action. The next time bias changes to the upside. Why? Because we're expecting the secondary test, which is going to retest the climactic action. So our bias has changed to up. And then the next day trading swing is going to be to the downside. So our bias is down here because we're expecting the secondary test to retest automatic reaction right here. And so on and so forth until you actually experience phase C. And after that, somewhere in this area, you're going to say, okay, I see that there's going to be a sign of strength and we're potentially going to go into a swing. So therefore, my bias not is only going to be up, but I'm going to switch the duration of my trade. And this is probably how I should say it. So duration switch from intraday to swing. Once we see a big gap, you're going to close that trade again on a lot of supply, so you don't want to stay with that supply. Change of character suggesting the consolidation, and we do. You might day trade a little bit here to the downside. And then again, all of this could be day traded based on the structure, but once we're here, here's your switch and a duration switch from intraday to the swing trade. So we can definitely see how this concept of being all-around trader is more beneficial than just being a swing trader or a day trader. A swing trader would be concentrated on only these moves right here. A day trader is still going to day trade even these areas right here, and obviously the swings to the upside, but there's going to be so many mistakes, there's going to be so many whipsaw trades, there's going to be so many losses that could potentially come during all of these areas. So if you could do both and just switch your mentality based on the technical conditions that we identify, then we definitely can benefit much more. And we are much more effective, efficient traders like that, rather than just thinking about, one concept here. Okay, some comments. Just to confirm, the bias changes based on significant bars. Okay, Karen, actually there are a couple of biases from a couple of places that we can extract, right? So for instance, if we are looking at let's say we're looking at the daily bias, right? So we are somewhere here. What is the daily bias, Karen, at this point? And by daily, I mean daily swing bias. Karen?
I guess it's down as long as yeah.
So why guessing? Why guessing? Why is we guessing here? It's a binary answer. It's either up or down.
As long as you're confident with the structure, in that last point of supply.
No,
then I
no,
guess
we're looking only at the daily swing
Oh.
bias, right? So we're not concerned with the structure right now. So what is the daily swing bias here?
So that's down. Yeah.
That's down. That's definitely down. Why is it down? Well, because there was an attempt to rally here, the reversal, and at this bar right here, there was no any other reversals. So the daily swing bias is down. So your primary trades during the intraday action is going to be to the downside. Okay, so then we're going to the lower time frame, and here we could think about a structural bias, right? Structural bias. So let's say let's define the structural bias. So during this whole time, the daily swing bias is what?
Down.
Down. Okay, so that's kind of like a big picture for us. But we see a change of character right here. So let's say for this session right here, what's going to be the structural bias?
For that last.
For this, let's say this bar right here.
So structurally, that's going to be down.
Yeah, because we're having some kind of reversal here after the automatic rally. We need to experience a secondary test. So our structural bias is to the downside for our intraday trades. So, and this is where two biases are going to be, you know, on the same page. So this is a high probability trade for us. We can even increase a position here, right? Then here, as we're starting to go up, what's the daily swing bias?
Still down.
Still down, but what's the structural bias?
Up.
Up, yeah. So we have this mix, right? So structural is up because we experienced a secondary test in B, and we are waiting for the test of the automatic rally, and yet the daily swing is up. So here you could have you know, a different sizing that you could have. You could have like half a size of the position, you know, in the opposite direction of the daily swing bias. Or you could totally negate that and you could say, no, the structure always going to supersede the daily swing because I might have the structures on the lower time frame, but the daily swing bias is going to be to the downside. So therefore, I'm going to trade the same size. So it's up to you. I actually put a lot of significance into the structural bias because, I mean, what about, like, there are quite a lot of day trading days right here in this area, right, where we have the up move and yet the daily swing is down, right? So how do you reconcile with that? Well, you just can trade it structurally. From the secondary test, we need that rally, so like this session is really good, this session is really good, this is the trade right here, this is the trade right here, this is the trade right here, this is the trade, and I'm just going through the intraday. So your bias is going to be, see how many profitable trades you're going to have here. You're not necessarily catching the down trades right here if you're trading just to the upside. But you can do that too, because during that time when you have both of the biases on the opposite sides, you could just use the reversal mechanism. And then with the reversal mechanism, you know, on the lower time frame, like right here, so let's say in this area right here, upthrust, our bias, daily bias, swing bias, is going to be a down. Our structural bias is going to be down here too because of the upthrust and this action right here. And then we're just waiting for the reversal on, let's say, 30 minutes, and it comes right here. So our bias here turns from going up to down as well. So 3 down biases right here. So we are in such a good spot right here. That's unbelievable. This is just like one of the best spots. Yeah, you know, when all everything is being confirmed. Okay.
Okay, great. Thank you.
And then Fawaz is asking, isn't that distribution? Okay, so let's come back to this chart right here. Okay, hold on for a second, Fawaz. Let me just unmute you. Okay, so which range are we talking about?
The one after phase D.
The one after phase D, right here?
No. Yes, exactly.
Okay, so because the price went up, consolidated, and then went up again, this is a reaccumulation for us, and we're going to call this a stepping stone reaccumulation. So the price resumes its move to the upside. Distribution would be something like, for instance, this is a redistribution right here, a smaller redistribution, where the price went down and then consolidated and resumed its course to the downside. And let's say distribution would be just, price going up and then consolidating and then reversing to the upside.
So when do we confirm it's a stepping stone rather than accumulation or distribution?
Okay, so stepping stone as an idea, as a stepping stone, is going to be confirmed once there is a commitment to the upside. An idea of whether this is accumulation or a distribution overall is going to be derived from the price structure, how the price behaves, and from the supply and demand. And this is something, again, that, you and I will work in April and May. This is going to be the primary material there, April, May, in the advanced Wyckoff course.
Okay, all right. Okay, I think I'm missing that part.
Yes, and see, for us, there is so much material there that I can't really, go there without, jeopardizing all of these intraday ideas. So for now, what I would suggest for you is just to, kind of like go with the flow of things, and then after you go through April, May material, it's going to become more evident to you, how to identify accumulation versus distribution, and then after that, come back to the recordings of this workshop, re-listen to them, and then it will become, much better for you to understand, what are we talking here, about.
Okay, that's fair enough.
Yeah, that's kind of like the only way that I see what's possible here. Okay, so any more questions? Great questions, guys. And for us, thank you for your questions as well.
Thank you.
Any other questions or comments on Amazon? And again, one of the main ideas is don't try to find the stocks to day trade that are gonna have sporadic momentum, that are gonna be popular just because of one day move, one day gap, and so on and so forth. I mean, you can create a lot of day trading strategies. You can create like a mean reversion after the gap trade, continuation after the gap. You can create, the most active stocks, how they're reacting. You can create the scans that are going to be like within the first 30 minutes, an hour, what are the most active stocks I want to go in there and establish, a position. You can do all of that. But if you are not having a lot of time, to scan for stocks like this and be quick in analyzing the stocks on the go, let's say if you're using first 30-minute scans, then it's better to stick to popular momentum stocks and just day trade them and be experts in those stocks. So you already know the structure of those stocks, and even something in the morning unusual happens for that particular stock, you will be inclined to do your analysis much, much quicker than with the stocks that you don't know. So therefore, for day trading stocks, I would only use the stocks that I know, that I understand, that the momentum stocks, and that the popular stocks, where we're going to have a lot of volatility. Okay, Now let's talk about general guidelines and rules for day trading momentum stocks. And here I have to put a couple of asterisks on my statements. First of all, these are my rules. These are my observations about day trading. They are not necessarily Wyckoffian ideas. Wyckoff wrote a couple of books on tape reading. So for a day trader, those are definitely must books to read. He talks about not necessarily the VPA analysis, but he talks about how price moves with the specific sizing of the volume, and that's the tape reading. So I think that in a way it's kind of like a lost art just because of computerization that we've had. We're looking at so much data, but imagine just standing by the telegraph and just looking at the quotes as they come with the size of the volume. And you kind of get the feel of how the stock is reacting on the intraday basis. And you do this day in and day out, and you can catch the changes of character so quickly. You could still do that. You can go to different levels that would show you different volumes, block of stocks that are being sold, and so on and so forth. So you can definitely do this. And I experimented with that, and I've realized that for me, it's just easier to rely on the structure, and it's just easier to rely on whatever volume signature I have at that time. Okay, so let's look at the guidelines and rules. So this is a different software that I'm using. This is a TradeView. By the way, guys, I started using TradeView, this year, and I'm actually having a lot of success with it. I think that it's very GUI supportive, friendly. It has the features that I want for all of my swing trading, the features that I want to have for my intraday trading. It's very intuitive. It has a lot of technical stuff that you can use, and this is kind of like a typical one stock picture that I would have on that software. So what I'd like to see is I'd like to understand the pre-market action. And even though there is such a low volatility right here, I want to understand structurally how that pre-market action becomes a part of the larger structure. So for instance, imagine if we wouldn't have this data right here, then we would have this change of character, and then we would have this low right here, and then the price goes up. So what does it mean? What is this point? Was there a price going down, up to this point? So I want to understand all of the things, and once I see them, it kind of makes more sense to me, to what that is. So here is your phase C, sign of strength, backing up action. And now it becomes a little bit easier to read the whole structure. Secondly, I use the pre-market activity as my support and resistance points. And it's going to become more evident from the E-minis case study, but for now, let's just look at this. So if I'm identifying the highest and the lowest point for my pre-market activity, and I also have let's say some support resistance points from the previous sessions, look how nicely the price is reacting around those points. And I'm using those literally for my support resistance points. If I'm looking for, if my bias, daily swing bias at this point is up, and I'm looking for all of the signals to the upside, then my favorite signals are all going to be around support area. And all three signals that I'm showing here are all near the support. Here is your support number one and the reversal. Here's your support number 2 and the reversal, and I'm saying that this is support. Why? Because the price committed to the upside, spent time consolidating, and then reversed. So this is a great reversal trade off the support that acted before as a resistance. Now, after the sign of strength, we have this big move to the downside, but it also comes to the support area, which acted before as a resistance. And then after the test, right here, this is going to be your next point of entry. So I like to look at the pre-market activity and the previous day levels for sure. Now let's go through some of the rules. Okay. First, define the daily swing bias. You want to know on any given day before you put on the intraday position, what is the higher time frame bias? And I'm putting here a daily swing bias, but you can also, let's say if you're trading Forex, you might say, okay, what is the bias on like 4-hour charts? And that also would be relevant if you're looking to trade, let's say 5 minutes, 10 minutes, 15, 30 minutes. Then you always want to trade a full-size position in the direction of that daily bias and trade lighter position during the counter trend move. And that's only if you're relying on the daily swing bias, right? So, and we've talked about what that is, right? So you want to define the swings as they are, and then give more weight to the positions in the direction of that daily swing bias. But you also can define an intraday structural position, and you can develop an intraday bias based on that intraday structural position. And we've talked with Kiran about that, right? So if we have, let's say, this structure right here, and I know that this is a sign of weakness, I'm sorry, a sign of strength. I see that there is this big reaction and a failure to go up, and there is a reversal. I might be thinking that here I am in the backing up action reaction. I still have quite a lot of space before the support level, so I might initiate an intraday trade to the downside at this area. Now, I also, for stocks and for E-mini specifically, I'm looking a lot to the time periods that I'm trading those, right? So, for instance, we're starting session on the Pacific Coast for me in San Francisco here at 6:30, and then we close at 1 p.m. I really would like, if there is a trade near support or near resistance right away in the first 30 minutes, I'm going to take that just because of the support and the resistance significance. If there is no reversal there near the support and the resistance, and the trade might be somewhere in the middle of the range, then I might wait for the first 30 minutes just to see what kind of intraday structure or intraday buys we're developing. And then during the lunch hours in New York, which is 9 to 11 my time, my preference is just, and I think it's right here, 11. My preference is just not to initiate a lot of position and to kind of like, don't even trade that time period at all. And you could see how all of these signals right here, they are either before 9 or after 11. And then during the last 20-30 minutes of the session, I try not to open any positions. For me, the last 20-30 minutes is all about either exiting or already I'm done for the day, or if I have the original position right here, this is a decision time, whether, and this decision is all about a switch. Do I switch from the intraday to a swing or not. And if I do, then what's going to be happening with my stop loss. So those are kind of like the time related to New York session and how New York session is being conducted and how we could see the trends usually in the morning. Volatility first 30 minutes, established trend, no non-trending environment, in this case it was trending, and then resumption of the trend or reversal of the trend, and then closure of the position or a switch to a longer term trade. What else? We talked about defining the pre-market boundaries. Okay, great. We definitely want to use the reversals near support and near resistance. So those are going to be crucial. So something like this, something like right here, I might be observing the price touching the resistance, and I need a confirmation of the reversal. It doesn't come on the next bar. The next bar does not reverse the low of this bar, so I'm still going to be in this trade. Next bar commits, and then we see a series of bars that consolidate here, but there is no really reversal. If I want to reverse, I need to reverse 1/2 of this bar, this level right here, and it doesn't happen. And instead, I see the next commitment to the upside on this bar, so I might actually add to the position right here, or if I didn't have a position, establish this position because I know that there's going to be a continuation after this successful test. So resistance and support and reversal around those areas are becoming really, really crucial. Okay, so now we know the kind of like the rules and guidelines. Now let's go into the case study where we're going to use these rules and guidelines. Okay, question from Karen. How do you decide which time frame to use? Here you have 5, earlier you mentioned 3. So that's going to be also a conversation when we're going to be talking about the predominant trend. So it's going to be crucial to identify, what is the time frame to use. It's also, somewhat of a discretionary technique, but I have specific rules for myself as to how to define that. Specifically, I would be looking, if my bias is up, I would be looking at the previous move to the upside, and I would try to find that predominant trend during this rally. What is the most cleanest and shortest swing time frame that I can put here? Can I put here 10 minutes, and would I take the whole swing? Could I go to 5 minutes, and would it take the whole swing again? Can I put 3 minutes here, and would that take that swing too or not? And if it's not, then I'm going to stay on 5 minutes, and I'm going to apply this 5 minutes to the next move in an attempt and in hope that the velocity is going to be the same. The trend is going to have the same time frame. And on another hand, sometimes you're just using a specific time frame. Like for specific markets, specific stocks, you already kind of like know that 5 minutes works really well, or 3 minutes work really well for the point of entry. And here, for me, always 5, 3 minutes are all going to be about points of entry. They're not going to be about, or I'm actually, looking at the trend definition there. So those 2 points. Okay, so now let's look at, and this is a great case study. I was having a lot of fun with it because basically that's kind of like a setup that I've used and that I'm using for day trading stocks, and also I'm using it to as an initial point of entry for swing trades. So the instruments that we're going to look at, I'm using the market proxy NASDAQ 100, Qs, and I'm using all 4 stocks here. Was it 4 stocks? Did I use 4? Facebook, Amazon, Netflix. I think I'm using only 3. Yeah, I can't use all 4. Yeah, so Qs, Facebook, Google, Alphabet, and Netflix. Okay, Facebook. We're not using Amazon. That's what we're not using. Okay, I'm looking at Alphabet and it starts with A, so it's just a little bit confusing. All right, so we're going to compare 3 FAN stocks with Qs, which is the market proxy. And we want to understand the comparative outperformance early on in the session. And that's going to be our selection criteria if we see any type of signals in the direction that we want to take. So basically, we are looking at the market as it gives us a signal. We're looking at the stocks, they give us a signal, and then the question, which signal you're going to take in which stock. So let's say that you can only day trade 1, right? You wouldn't want to day trade 2 stocks or 3 stocks that are going to be in the same industry group and they're going to have the same kind of like momentum characteristics. Why? Well, because you're basically increasing the risk in the highly correlated stocks. So whenever you run, you basically, you know, doubling your losses there. So when you're right, you just want to be right in a big way, and you want to pick up, you know, this stock that is definitely going to outperform. So let's look at this. The first thing that you're still going to do is you're still going to look at the daily bias. So here are the daily charts for all 4 instruments, and I'm looking at all of the trades that we're going to look at are going to be in, hold on a second, in this area right here. So we're going to look at 4 days. I believe it's going to be this one, this one, this one, this one, or maybe this one. 4 or 5 days we're going to look at. And I want to define the daily bias right away. You know, what's the majority of the trades, intraday trades, that I'm going to take? Are they going to be to the upside, or are they going to be to the downside? So the reversal has happened in this area right here. If we thought that maybe this bar right here, which is covered by this box, has reversed this last bar to the upside, then this bar definitely reverses again. So we are in the daily swing bias, which is up for Qs. And we go to Facebook and we do the same thing. So there was a reversal right here by this bar to the downside, so we had a downswing. But by this bar right here, we are coming up above and committing above 1/2 of the latest spread to the downside, so the bias is up here. On Google, we definitely committing below on this bar, and then this bar is being reversed by this bar right here. We are above 1/2 of the spread, even on the true range, so up. And then Netflix was very interesting. I was talking to my associate about this particular chart, and he was saying that, you know, it's not evident that, you know, this bias is down at this point, which I would have to disagree with, because the last commitment to the upside we had here, then we definitely and very clearly reversing this commitment. And if we want to reverse the this bar, we need to see closes above 1/2 of the spread. So we are probably somewhere in this area right here for the commitment. And then all of these smaller bars are creating new commitment line. So this new line or new lines were never reversed properly. So we're still in the downtrend here in terms of the swing commitment. Maybe on Monday we're going to have a bar like this, which is going to basically say to us that now we have reversed. But for now, our bias is going to be down. And please look at this, look at all of these bars relative to, let's say, these bars right here or these bars right here, or even for the market going up. So I think it's actually a very good call right here, with all of this, biases, and specifically identifying that if there is a trade to the downside, I'd rather take Netflix than Facebook or Google. So now that we know daily swing biases, and this is kind of like a long-term picture for us, let's go to a specific day. So this was March 10th. And again, one of the things when we start the session is to understand what kind of volatility we're going to have after we understand the daily bias, what kind of volatility we're going to have within the first 30 minutes. So this is a 5-minute chart, and 7 o'clock is going to be somewhere here. And we kind of want to identify the range of that 7 o'clock. And we want to understand, is the market going to go up, or is it going to commit to the downside? If the market commits to the downside, then is it really profitable for us to trade up on that day? Most likely not, right? Unless there is some kind of reversal in the market in the opposite direction, and then we could start trading, in that same direction. But here we see that after the first 30 minutes, the first commitment below the support is actually to the downside. So we would be inclined not to trade any stocks that are stronger than the market, because their movement to the downside might be a little bit less, and therefore we are not going to have a really good move to the downside. And that's kind of like evident from the alphabet right here, where, if the market committed on this bar right here, we still don't have that commitment to the downside based on the lows here. And then the whole action here is just, consolidating. This was a much better move right here, but we would probably never put on the downtrend here because of how strong the stock is, and it's still stronger than the market, at this point right here. So the only candidate for us on when the market is showing us a commitment, and an intraday commitment, is to go to the one that already has a down bias. So we can open this trade just based on the breakout of the first 30 minutes, which is going to be somewhere here. So we would identify the support and resistance, and we have that commitment to the downside. So we can just plainly just open the position to the downside, put the stop loss somewhere at the nearest, attempts to go up in that failure. And then we could either follow the market and synchronize the exit with the market, or we could just use exit techniques here. You could exit somewhere here, or if you are switching to different time frame, let's say you're switching to 15 minutes time frame, from 5 to 15, then your exit is probably going to be somewhere here. And that's your trade, either this one or this one right here. Now something happened during this day where we had moved to the downside, and we see that the volume is increasing. We see that the price velocity has increased here as well. We have the test, which is a lower low, but supply has contracted, and then we have even lower supply right here, but a higher low. So by the conventional Wyckoff definitions, this is an absorption of the supply, and we have the reversal. So at this point, we're going to be looking for any of the trades to the upside. And please note this happens around 11 a.m. Pacific. This is where the lunch session is done, and therefore you might expect either continuation of the previous move, or some kind of reversal in the opposite direction. So reversal is happening right here, and what would we be trading? We don't want to trade Netflix anymore because of the down bias. We want to trade something that is going to be stronger than the peers in the market. So as I look at, let's say, this picture right here, and I'm looking at this picture here, it seems that the market is stronger than Google, but it's also a higher low, so also a possibility. But as I look at Facebook, it seems that Facebook is behaving much, much better than both Google and the market. So that would be my preference and point of entry somewhere here with the stop loss either below here or below here. And basically, I would keep this position until the end of the session, or I would look at the significant bars and I would just basically exit at the reversal of the significant bar. And this is what we would have, you know, for that trade. So this is, let's just round this out. Well, 106, maybe 35 to about 107, 35 too. So this trade, and then we had a trade, let's say right here. If we're exiting at this point, 97, 98, so that's a buck here. And then if we're trading it, you know, to a much more logical, actually, you know, you could probably somewhere here, so buck and a half. So and these are the two trades that if you're trading stocks and if you're trading, you know, momentum stocks like this, these are the two trades that you might have on this particular day. Now again, see how easy it is for me to come in the morning. This is the setup that I have in my trading view, and I actually had this setup and I started using trading view just recently, you know, at the beginning of this year. But this is it right here. This is the website. This is the page, and you see that I'm synchronizing. You know, I could look at any of the bars here. I could go to any of the time frames that I want. Let's say 5 minutes. And right away, I have all of the structures that I need. I understand the swings here, and I have all 4. So I can do a comparative analysis right away without even thinking about this, right? And right away, I could see that, okay, yesterday, the market went down in the first 30 minutes. There wasn't really a breakout. After 9 o'clock, that's when, and after 11, this is where we would have, you know, some kind of move right here. So unless I see any stocks that outperforming in the first 30 minutes, in the first hour, I probably might not even consider anything. So what are the stocks that are going to be outperforming? I see that here the market is really weak. Facebook is kind of like the same weakness. Google, same weakness, but then Netflix is actually behaving differently. And we saw how Netflix started to change its character in the latest 2 days. So you might also consider just looking at the whole structure. And you might be thinking, okay, well, where am I right here? So definitely there is an upward bias right here. So can I open an intraday position just based on the strength that I see at this point? And I think that you can, because within the first 30 minutes you have a gap up instead of the movement to the downside. The retest is actually at the higher low, whereas the retest here is just a part of the reaction. And then as the price, so much stronger opening. So you would be attracted to the stock. You just want to see some kind of reversal on the intraday basis. So you can come in and into this bar right here as a reversal of the big bar, but that also suggests that there is some supply, so there could be a retest. So you could wait for the retest and then enter on this bar with the stop loss somewhere here, or you could wait for a more meaningful breakout action, like on the bar like this. And I think that this is one of the best moves. I mean, just comparatively, you are at much less risk here with this stock than, let's say, with the stock like this or with the stock like this. Even though they both went up and the market went up as well, this is a much less riskier trade. Okay, so let me move this back. Okay, so that was the first day. Let's look at the next one. So this is 11th. The market opens up with the gap, and we have the first initial move. Here's your first 30 minutes. We see a commitment to the downside and instant reversal back. So once this is happening in this area right here, we would be thinking we definitely want to see, you know, what kind of, we're having the daily bias up, and we want to see, was this come back to the trading range, you know, come back to this first 30 minutes trading range. We want to see what stocks are going to be much stronger than the market. So let's just go through those. Also opening up with the gap, so that's great. But we're also having a lower low right here. So we are kind of mimicking the market a little bit in Facebook. Netflix opening up and just going down. There is no really any type of attempts even to go up, except for this bar and just failure and failure. So that's not going to be an attractive stock for us, you know, to trade to the upside. But Google is very interesting. It creates a high low instead of the low low, like here in Qs and Facebook. And this is definitely something that we're looking for in the same type of gap. So we might be opening a position right away right here and just either closing it before 9 or just keeping it as we see that the market is trying to commit to the upside. And then we could use the 9 to 11 as our stop loss period, where basically we're defining the lows and the highs, and if we're trading to the upside, after 11 at 11.05, we're just going to move the stop loss below the lows at 11. And this is obviously Pacific time. And then as the price moves to the upside, we're just moving the stop loss and then just exiting, you know, at the end of the day. So this would be a really good trade, about $4.50, almost $5, around $5. And obviously this is a high price stock, so you know, but still you're making a good you know, number of points here, and you're picking the stock that comparatively should outperform the market and the peers. It doesn't mean that it necessarily will outperform, but it definitely has a much better chance to outperform. Next day, 14th, and we see that the market opens up with the gap and then creates a higher low and then reverses, and there is an upward movement. After 11, we have another signal. We'll talk about that. So at the beginning of the session, which stock are you going to choose? So it seems that Facebook is having a much stronger gap to the downside, so it doesn't gap down as much. Much larger move to the upside on the second 5-minute bar, continuation of the rally, whereas market is already going down, and then a higher low after the first 30 minutes. So the boundaries of the for us for the first 30 minutes are defined. The boundaries here are defined as well. Here is the commitment to the upside. Netflix is also very positive, very strong opening, even though there was an initial gap, but you know the gap bar ended up actually in the previous session pricing, and then again strong move, strong continuation, and a higher low. And here are the boundaries for the first 30 minutes. And then Google has the best opening out of all 4 instruments. See how on the first spread, on the gap spread, it actually gaps up, then tries to go down, goes up, and closes up above the previous day's short-term commitment line right here. And then it consolidates and never actually comes back down to this area. Here we have a comeback. Here we have a comeback. This comeback is probably much better than this one right here. So from that perspective, this is the strongest stock in the first 30 minutes, and we're just waiting for some kind of reversal. And this reversal for this stock comes, in this area right here. So whenever you open the position here, it's going to be fine. And this is what you have. So comparatively, we have a movement to the upside in Facebook, but look how comparatively we are outperforming here in Google on this rally. We are moving up, but just, a much more reserved move here. And then for Netflix, comparatively, we can't even overcome this high. Whereas here we're overcoming it, here we're overcoming it, the market is overcoming this high as well. So Google was much better candidate on a comparative basis here. And I think that right now you probably already have a really good idea of, how I go through this selection. And what helps me is I know exactly the stocks that I'm going to be looking at in the morning. I know it's going to be Facebook, Google, Netflix, and Amazon, because those are the momentum stocks currently. They're going to change, and I'm going to change the stocks, from time to time. And sometimes I might have 6 or even 8 stocks to look at, and TradingView allows me, that type of view, and TradeStation also allows me to create, like 6, 8 windows. But I think that anything beyond like 4 or 5 stocks is actually too much. Secondly, I know the structures of the stocks in and out, so I know exactly where they are in terms of their trend characteristics, in terms of their trading range characteristics. So I don't have to think in the morning about a long-term structure. All of the buys is already defined except for the intraday buys. So in the first 30 minutes to an hour, all I'm doing is I'm observing what the stocks are doing, and I'm defining that intraday comparative strength and intraday structure. And I'm picking the stocks that are trending, are giving me a signal in the direction of the daily swing bias or in the direction of the structural bias, on the higher time frame. And I'm picking the ones that are going to be either stronger or weaker. And that's it. And that's how simple it is. In a lot of cases from day traders, sometimes I see a little bit overcomplication if you like using all those scans, in the first, like you can use the scans even in the pre-market. Okay, in the pre-market you can scan, let's say like at 6 o'clock for the stocks that are most active pre-market. So therefore the logic here is that you're going to anticipate that there's going to be some kind of, trending day there. Well, that's true, and I can't avoid some of the days being, dull days. but I can look at E-minis, I can look, you know, at other instruments as well and create some kind of opportunities there. I can also look at some of the intraday trades that created a swing trade for me, so I might not even day trade at some of the point on that swing trade. Okay, so let's finish this up. There is, I think, one more, and then what time is this? Okay, yeah, there is time for one more slide, and then we're going to stop for the break. Okay, so this is the 15th, and you know, I tried to bring like more current data so that, you know, for those of you who actually trade these stocks, day trades these stocks, you know, you guys kind of like, you know this price action. So we're still in the daily swing bars, which is up. The market gaps down and creates a lower low, and then after an hour it creates a higher low right here. Google gaps down as well, kind of like the same structure, slightly weaker at this point on the higher low. Netflix, the gap is much stronger, but there is definitely a continuation of this movement which we don't like. You know, these two bars attempts to rally everywhere, they are much higher than the low that we've had right here. And here we just can't even, you know, come up to this level. So much weaker. At the point of the high low for the market, the only stock that I see that is stronger at that point is Facebook. And Facebook is consolidating almost on the top of the hourly structure that we've seen here. So therefore, this is going to be my candidate. And I'm just going to be looking for the reversal of this swing to the downside, which comes right here. And this is going to be my trade. Up to this point right here, here is my exit, and here is the intraday trade that I was looking for. Now, I'm not going to be looking for any of the signals between 9 and 11 in the market, and there is nothing else left here, so I might not be even interested, you know, in any other trades that, you know, I'm going to have here. So therefore, no trades here, no trades here, and see how I'm eliminating some of the unnecessary trades that, you know, I would be inclined to do if I wouldn't have a daily bias, if I wouldn't understand what the market is doing, if I wouldn't understand the comparative analysis as well, if I wouldn't understand the structural analysis, you know, at this time frame. All right, so let's see if we have any questions. So that was it for this case study. Now, the question, can we look at how we apply this selection process to Forex, please? Yes, we can definitely do this, Karen. Why don't we do this? So the process is going to be somewhat the same. There's going to be some specificity to the Forex market. And let's do this in the Q&A session. Okay, so here's my alarm. Let's do this during the Q&A session, and we'll just pull out, you know, I'll pull out the TradeStation, and we'll look at the currencies that way. And we definitely would need to look at the correlated currencies, you know, so for instance, like, you know, pound, euro, and so on and so forth. Okay, guys, so this was the alarm for our lunch break. Go have fun with your lunch. Come back at 1:15 Pacific time, so in 45 minutes. I didn't want us to go for a whole hour. I mean, I'm assuming that everyone's home or maybe in the office, so 45 minutes should be sufficient. And then when we come back, we're going to start looking at, we're going to continue with stocks. And then I'm excited, you know, to talk about the E-minis in the fourth session. All right, guys, I'll see you in 45 minutes. Talk to you then. Thank you. Bye-bye.